A very good morning to all of you. I welcome today's speaker, the members of Bangalore Valuers Association, the BVA committee members, and the non-BVA members who are attending this session. This full week, I hope you all have enjoyed the Ganesha celebrations. It is believed that when the idol of Ganesha is taken out for immersion, it also takes away with it the various obstacles, and these obstacles are destroyed along with the immersion. Let all the obstacles in our life be destroyed. Usually it is the immersions are planned on the weekend, Saturday and Sunday. Let's begin a very fresh weekday from Monday onwards. Coming back to our topic today, Mrs. Ranganayaki has kindly agreed for our request on such a busy schedule. All of you must be aware that this time of the year is very busy schedule for all the professionals, and Madam has kindly agreed our invitation. Thank you, Madam. When it comes to corporate restructuring, all of us agree that a lot of challenges will be facing, be it amalgamation, merger, demerger, because the report is directly submitted to the statutory authority and it goes to a scrutiny. And in case of any query, maybe the professional could be summoned or expected to give certain clarification letters. And yes, that is why we have chosen this topic for today. And now I request Kusum to formally introduce the speaker to all of us.
Thank you, Shilpa, for setting the tone for today's topic, valuation and corporate restructuring. We all know why a restructuring usually takes place. Restructuring is a way of changing a business or group with the goal of recovering it or to make it more profitable. So it has the overall aim for improving the operational, financial, legal, or other structures of that particular business so as to maximize the profit and to ensure efficient operation. For the business restructuring to be effective, it will need the joint efforts of various stakeholders like the business expert, the company's management team, and other stakeholders like the professionals. And now we have with us this morning Miss Ranganayaki Rangachari. She is a practicing partner in Ritu Ranganayaki and Company, chartered accountant in Mumbai. She specializes in consultancy. She is, she is a graduate from University of Madras. She is, she is a multifaceted professional. She has completed her CS from Institute of Company Secretaries of India. She's a CMA from the Institute of Cost Accountants of India. She's a chartered accountant from the ICAI. She's a registered valuer, under securities and financial assets from IBBI. She is also a registered insolvency professional. She is a certified independent director from IICA. She has also completed her course in GST from ICAI, and she also is a mentor, and she is also a she actively participates in all these leadership development programs. She is also a rank holder in ICWA Inter. So we are indeed very privileged to have you, ma'am, this morning with us. We know that you have vast and varied experience in working in India as well as abroad in various industries, be it retail, be it offshore survey, be it shipping, private equity, print media, and you have also worked in various sectors, such as the media sector, such as the retail sector. So considering the fact that you have handled project implementation, fundraising, FEMA compliances, FIPB approvals, we know that you can actually bring a lot of value this morning to all of us at BVA, members as well non-members. We welcome you this morning to deliberate on corporate restructuring, ma'am. Thank you so much, and we request you to start the session.
Thank you very much, Kusumji, for that warm introduction, and Shilpaji for the invitation. And I don't know what to say. I see all the Diggaj on the participant list, and I've taken one of those, a daredevil step of getting into a complicated area of corporate restructuring. But why I chose this particular subject was, many times as valuers, we understand the valuation aspect of it, the law side of it, or the technical aspects of it, How much we are, clear into that is something I just wanted to dwell upon. 1 minute, let me share my screen and can you give me the rights to share this? Okay, I got it. Is my screen visible to everyone now?
Yes, ma'am.
Yeah. So with that, I just chose this topic. Valuation is something you all are aware, what you do. But what is the background process? What are the court judgments and how it is going to make an impact? And how various authorities look at a valuation report in various forms. That is what we are going to discuss upon, largely on the broader sides of the valuation side and on the legal side of the company or company law aspects and things like that. So good morning, everyone. Thank you so much for the warm invitation. Today, we are going to discuss on an important chapter in the company law, wherein the major aspect of valuation is touched upon. Except for this chapter, we have only a private placement. We have 60 to 42. But the major aspect of valuation is dwelt upon only in the corporate restructuring, which is there in from section 230 of the Companies Act. So before we get into valuation, let's quickly get into, maybe in another 15-20 minutes on the legal aspects of it. And then we discuss further on valuation side. Why do we do corporate restructuring? There are two ways to grow an organization. An organic way of your own internal growth, increasing your sales, expanding the market and things like that. And there is other way of growth in the organization called inorganic growth, wherein you accelerate your growth by acquiring companies, by demerging what is not a part of your core business and enhancing the value for your shareholders. End of the day, whatever we do, it is all upon enhancing our stakeholders and shareholders' wealth, and that's what precisely corporate restructuring is trying to achieve for us in various forms of benefits. Could it be a tax benefit as well? So corporate restructuring is defined as a process involved in changing an organization of business. It can involve dramatic changes. So we have mergers, we could have demergers, we could have amalgamation, we could have acquisition. When we put it up in two different baskets, I just said there is an organic way when you increase your business value by increasing your customer base, increasing their sales, increasing the revenue, increasing the market share, getting into various other geography where you are not present. This is an organic and traditional way of growing your business, wherein there is no fundamental change in the organization, the way you try to develop your organization. In the inorganic way, we have the mergers, acquisition, amalgamation, and divestment. It's a huge area of practice, not only for valuers, but from the other professionals as well. So that's a huge area of practice available for professionals like that. Why corporate restructuring? Somebody might be having a surplus cash and somebody is looking for cash, and their milan, their merger is very important, or their synergies are important. The other aspect is there could be an operational synergy in terms of saving of cost or increasing your profitability, using your available resources to the best possible, or you want to diversify and reduce your risk, or risk not mitigation, but risk enhancement, in the sense by diversification. You can develop by demerger, you can develop on your core competencies and demerge what is not your major business. You can improve your competitive position. You can exploit the strategic assets accumulated by the business. And again, last but not the least, enhance your allocation of managerial capabilities. Largely, many large corporates, when they go for it, the better form of efficiency come in form of managerial capabilities. Economics of sales, we don't have to discuss. As student of costing, we all know the economies of scale will come in. You get into entry into new markets and new business. Can be domestically, it could be international. You get a large variety of audience by doing this corporate restructuring. Corporate restructuring could be taken in form of acquisition, a company taking over another, a merger, demerger, reverse mergers, disinvestment, joint venture, strategic alliance, and slump sale. Let's quickly, in a minute or two, let's touch upon each of these aspects of corporate restructuring. Let's start with merger and amalgamation. Merger, we all know it's a combination of two or more companies. It's a way of amalgamation or absorption, or by formation of a new company. when we do merger and amalgamation, we remember our accounting standards and Ind AS, either it is pooling of business interest or purchase method under Ind AS and accounting standard, pooling of business method. Offering the stockholders of one company securities in acquiring exchange for the surrender of their stock. Amalgamation as such a term is not defined anywhere in the Companies Act. We get the clue from section 2(1)(b) of the Income Tax Act, which says amalgamation, in relation to company means merger of one or more companies with another company, or merger of two or more companies to form a new company. What are the basic conditions for amalgamation or merger? All the properties of the transferred, the transferor are transferred to the transferee. All the liabilities are transferred to the amalgamated company. The shareholders holding at least 3/4 in value of the shares of the amalgamating company becomes shareholders in the amalgamated company. This is a typical, a combination of an amalgamation, wherein 3/4 in value of shares of the amalgamating company become the shareholders. So the kind of the shareholding percentage is kind of maintained. In case of listed company, we need to keep in mind if one is a listed, the other one is an unlisted. Your SEBI requirement of having minimum public holding should be taken care. That is a major consideration in case of amalgamation or merger. The properties are transferred to from the existing companies to the new company, to the amalgamated company, and the shares are issued. The very important aspect or a typical aspect of amalgamation is the amalgamating company is dissolved without going through the entire process of winding up, which is given under the Companies Act, which is a quite time-consuming process. This is the biggest advantage of a merger, that you have an amalgamation and the original companies are dissolved without going through the process of dissolution. The modes and mergers of amalgamation could be horizontal, wherein the companies are on the same level in the compete industry. See, Vodafone is taking over Idea, or one bank taking over the other. So they are at the same level. They are doing the same kind of business and they are competing with each other. Whereas in a vertical merger, we have a combination of two companies which are operating in the same industry, but they are under different level of distribution or production, wherein they can combine their resources and get a better value for their shareholders. So it's like Walt Disney acquiring Pixar or eBay acquiring a PayPal. They are in the same industry, but they are in different stages of production or distribution channel, wherein they can efficiently use the combined resources of the organization once the merger or amalgamation is completed. The third form is a co-generic merger, wherein two companies are in the same or related industries, but they don't offer same product, but they are related products. Again, they unleash their synergy, like Zomato offering grocers. Both of them are able to get the use of the same distribution channels and providing synergies for the merger. So there, the thought process for merger is totally different, wherein they are trying to combine and unleash each other's available potential. So the synergy comes into play in a greater form in case of co-generic merger. In conglomerate merger, the mergers are from different kinds of businesses under one flagship company. The question which came up in company law was, do you having a diversity of objects, can two companies be ground for amalgamation? This was tested in the case of Steel Kingdom Netcom Limited, wherein the courts have held that two companies, the diversity of the objects of two companies cannot be a ground for declining a sanction to the proposed scheme of amalgamation. So if the objects of the two companies are totally different, that cannot be the reasons for rejecting the amalgamation process. Here, as a valuer, we have to understand the two different companies are working in a different businesses. The valuation for each of the business could be from different way of valuation, like we apply for any other thing. And then the combined value is looked at from the management side, looking at the synergy aspects of the business. See, the other form of corporate restructuring is acquisition. So it is like, entity acquiring smaller entities, all big fish is always looking for the small fishes, and trying to buy them. There, The real reason for these acquisition or takeover is there undervaluation, the potential for scale up, and to achieve market supremacy by the larger player. So the acquisition could be a friendly takeover, so with the consent of the management of the company, and it could be a hostile takeover, acquisition of target against the consent of the target company. The great example is L&T and Mindtree. The challenges in hostile takeover, we all understand. Demerger is again a reverse of a merger, wherein the business which is not in the core business or in the core value are demerged into a new company or moved into another undertaking, wherein the major company concentrate on their core business. So the company hides off or separates one or more of its undertaking into another company. Undertaking is transferred as a resulting company. So that's a resulting company. Company which transfer the undertaking would be the demerged company. So the parent company is a demerged company, and you have this one. The great example is, Pyramid Industries demerging their pharma and financial services business. This is another area of corporate restructuring, wherein one or more undertaking is transferred for a lump sum consideration, and individual values are not assigned to the assets and liabilities. Here, for accounting, then the fair value has to be ascertained, and the value has to be given to each of the assets. And this is one area of valuation requirement, wherein the lump sum is being paid, how to assign value to each of the assets and liabilities and account it in the books of the company. Reverse merger is opposite, wherein a unlisted company acquires a listed company and becomes a listed company without going to the market to become public. So unlisted company becomes a public listed company without opting for a IPO. So the private company acquires a major shares in a public company and it goes into the market as a listed company. The largest example is ICICI Bank with the ICICI Group. They went to the market as a listed company, though they were being a unlisted one. Disinvestment is, we all know, the government is liquidating their shares to get in more revenues. So this in a government entity sells certain part of their shareholding in the company and it's given to the public. So Air India and Tata and LIC and other examples. Joint venture is Maruti and Suzuki coming in, entity formed by two or more companies to undertake a financial activity together. The joint venture could be a project-based joint venture or a functional-based joint venture. The parties, they agree to contribute to the equity and form a new company. They share the revenues, expenses, and control. This is the real structure. The challenges faced is capital reduction, companies consolidation. So valuation aspects in any of these corporate restructuring comes later. The first is the thought process behind any of these corporate restructuring. What is the synergy they are trying to get it? Is it an operational synergy? Is it a financial synergy? So operational synergy could be, as I said, the expanded market, larger customer base, the profitability, the enhanced cost, so the reduction in the cost and increase in the possible profitability. Whereas in case of financial synergies, it could be because of their combined capital, wherein the cost of capital could be reduction. There could be tax savings, and there could be other financial implications, which gives a savings to the organization. So the thought process for any of these corporate structuring has to be first done at the boardroom. The people will discuss, find out their synergies, and then they will come up with the idea of whatever is the structuring mode. And then comes the valuation exercise for the entire process. So under the Companies Act, the entire merger and amalgamation chapter is taken care under Chapter 15 of the Companies Act, which talks about compromises, arrangements, and amalgamation. Under the new act, the advantages, instead of going to a court, it has gone to the NCLT. The process is faster, easier, and cleaner. Having said that, we find a lot of delays in NCLT also. But having said that, the intention was to fast track the entire process. and to get it through NCLT rather than to go to a court and take that, consume their time. And the Companies Act 2013 talks about fast track mergers, wherein a wholly owned subsidiary can be merging its subsidiary with it, and even small companies can do it without getting into this entire longer process of going into NCLT. And the Companies Act talks about merger between Indian companies and foreign companies and vice versa. The cutting down the probability and scope of the entire process of the Companies Act 2013 requirement is, or the objective is, to ensure that these corporate restructuring happen in the fastest, quickest, and the economical, in the cheapest way it could be done. So the other advantages which have been introduced is people can participate, the shareholders can participate through the postal ballot. So the lot of ease of doing business is being included in the Companies Act. When we talk about corporate restructuring, there are a lot of acts which need to be kept in mind, whether as a management when you're preparing your restructuring process, whatever is the program you are trying to give in, or the product we are going into take it to the shareholders, or as a valuer. There are multiple areas of operation which are the areas of various regulations we have to keep in mind. Companies Act, of course, 230 to 240 is the guiding section, so that has to be kept in mind. In case of listed companies, SEBI LODR compliances, the valuation required under substantial acquisition and takeover codes, delisting things, all these things have to be taken into account. For the purpose of accounting standard 14 or Ind AS 103 has to be kept in mind. FEMA aspects have to be kept in mind. So the basic fundamental of FEMA is, when there is an FDI come in, the value should be, the money pumped into the Indian economy should be equal or more than the fair value of the determined by the valuation report. Whereas in case of ODI, the valuation, if the valuation is there, the outflow cannot be more than the valuation determined by the valuer. So in case of FDI, there is a floor value, and in case of ODI, there is a cap value. So that needs to be kept in mind. And the interplay of valuation section between Companies Act and FEMA. Under Companies Act, you can't issue shares beyond the determined value, fair value. Whereas in FEMA, in cases of FDI, you can bring in more or same, but it cannot be less. In case of ODI, vice versa. Those things have to be kept in mind in terms of FEMA requirement. In case of cross-border mergers, the approval of RBI has to be kept in mind. In case of even certain cases, regulatory, the sectoral regulator approval is also to be kept in mind. In case of banks, NBFCs, the RBI approval is required. In case of insurance company, your IRDA approval is required. So depending on the sectoral regulation, the sectoral regulatory approval is also required. If the turnover or the value of the market share of the company is beyond a certain threshold, Competition Act comes into play. Then the scheme has to be presented to them. Income tax comes into play. Income tax valuation rules comes into play. Stamp Act comes into play, because the entire order issued by NCLT is a decree on which stamp duty has to be paid. So a whole lot of rules and regulations have to be kept in mind when we are doing a corporate restructuring. The entire chapter 15 of Companies Act 2013 talks about the compromises, arrangement, and amalgamation. We will not get into each of these sections, but quickly let's understand what are these sections. 230 talks about the power to compromise or make arrangements with your creditors and members. 231 gives the power to enforce the compromise or the agreement arrangement by the court, the NCLT. 232 talks about merger and amalgamation of companies. So we have valuation requirement under 230. We have valuation requirement under 232. And 233 talks about merger and amalgamation of certain companies. 234 talks about amalgamation of a company with a foreign company, wherein the interplay of Companies Act and FEMA comes into play. Then in 235, it talks about the power to acquire shares of shareholders from the dissenting or dissenting from the scheme. So the value has to be finalized, and it should not be prejudicial to the interest of the public shareholders. That needs to be kept in mind. 236 talks about purchase of minority shareholding if the management wants to buy. 237 talks about the power to the government to provide for amalgamation of companies in public interest. 238 talks about offer of scheme involving transfer of share. 239 talks about the powers to keep books and papers. And 240 talks about when there is a corporate restructuring, any offense or any liability committed prior to the the NCLT will always look at an amalgamation or a merger or a demerger thing. The intention should not be defray any of the existing laws. And at later point in time, if it comes to the knowledge that there were some offenses committed, the responsibility will still remain with the management of the erstwhile company. That specifically is spoken about in 240. So when we look at 230 talks about the compromise or arrangement with creditors and members. In this, the company can make an arrangement with the creditors or the members, how it is to be done. You should have the approval of at least members consenting 70, in case of creditors, not less than 75% of the secured creditors in value have to give their approval. There has to be compromise or an arrangement shall be submitted to the NCLT. It should be accompanied by an affidavit saying that all the material facts of the company, that consent from not less than 75% of the secured creditors. It should be along with the auditor's report saying that the funds are available after the corporate debt restructuring and the liquidity test. All these things have to be done. Along with this, a valuation report in respect of the shares and assets are also to be attached to this affidavit. So this is a document which is going to go to the NCLT. The notice, then the notice is given to the members. The meeting is conducted as required under the law. Shareholders no holding not less than 10% of the shareholdings or persons having outstanding debt who have got 5%. In case of the threshold limit for shareholders is 10%. In case of persons having outstanding debt is 5%. These people are entitled to raise their objections. So if a shareholder is holding less than 10% shareholdings, they would not be able to raise an objection, or in case of a secured debtors, less than 5%, they will not be able to raise an objection. So if those objections are there, then that has to be taken to be consideration. The meeting has to be conducted. The notice of the meeting has to be done. The meeting has to be conducted as per the requirement under the law. The scrutinizer would be there, and all these things have to be fulfilled. And the notice meeting should be sent to the central government, income tax authorities, Reserve Bank of India, SEBI, Register, RD, Stock Exchange, and Competition Commission. The real issue comes in there. When the notice is given to the stock exchange, they have to give their no objection certificate. They are going to look at the valuation certificate given by us, and they are going to make their comments, and then they will forward their comments to the board, SEBI, and then the no objection certificate will come, or an objections will be raised, and that is to be answered by the company suitably. Many cases, if you speak to the stock exchange authorities, they question the valuation report issued by us. They say, in fact, in one of the occasion, I was traveling with one of the officer who in charge of giving NOCs. He says, ma'am, you people give us valuation report. We see suddenly, there is a beautiful rosy picture projected by a company, whereas till last year, I see there is accumulated losses, accumulated year on year. How is these valuations arrived at? So when we are making a valuation, the entire assumptions, the business thought process, and our assumptions, premises, and the calculations have to be substantiating with the report what we are providing it to the company, because These reports are looked at a microscopic level, and many a cases, stock exchanges are raising their objections for those valuation or to the compromise of the arrangement scheme given by us. So the entire scheme has to be passed by people having 3/4 in value of members or in creditors. Only when it is there, it will go, in case of the scheme is approved, these tribunal shall be, when it is passed by these members, it will go to the tribunal, and once it is sanctioned by the tribunal, it will be binding on the company, creditors, and liquidators. The order of the tribunal sanctioning the scheme to provide for certain matters, how it should be implemented. If you need, you can go to them for directions, and all these things are given under the order of the tribunal. The order of the tribunal should be filed with the registrar to the registrar of companies by the company within 30 days of receipt of order. When we talk about appointed date and effective date, we'll touch upon this aspect in little detail. In many cases, if you have approved, your affidavit from your creditors, then the NCLT can dispense of calling a meeting of the creditors. But at any point in time, the meeting of the shareholders cannot be dispensed at all. Only the meeting of the creditors can be dispensed if you have the approval from 90% of the members. The powers, then 231 talks about the power to tribunal to enforce a compromise or an arrangement. 232 talks about the merger and amalgamation of company. So this is the major aspect of corporate restructuring. So before you decide on a merger or an amalgamation, the background and identifying the benefits, whether it is an operational synergy or a financial synergy, what are the combined benefits you are going to get, all those things are going to be identified. The regulatory requirements have to be checked, as I mentioned, whether under SEBI or under FEMA or under Stamp Act, whatever, all the regular or the sectoral approval from RBI or IRDA has to be identified. Then the time frame and the cost benefit analysis is to be done. Then there is an appointed date for the compromise or the scheme. Appointed date is a date wherein the assets and liabilities of the organization, the erstwhile entity moves to the other entity, whoever, in case of amalgamation, merger or demerger. Then there is a due diligence process done on the transferor company. The valuation of shares and the exchange ratio is determined. The valuation and exchange ratio is going to be determined on multiple factors, depending on listed company, unlisted company, what kind of observable inputs we have, level 1, level 2, level 3. Depending on that, valuation of shares has to be achieved, and the report to be given, and the accounting implications will be checked by the company. The statutory approvals will be taken, and the scheme will go to the NCLT for approval, and the scheme gets approved.
I have a doubt here.
Yeah.
What should be the valuation date? Like, the date on which both the companies are valued. Can it be appointed date or any other date?
It can be an appointed date. It can be any other date also, because in a few cases, NCLT has rejected the case saying that, the valuation date and the appointed data are not matching, and hence, the scheme cannot be enforced. And it has gone to NCLAT, and it has very clearly said appointed date and the valuation date do not have any requirement. In fact, I'm going to discuss a little deep into appointed date and the effective date in the few of the next slides, wherein we'll say what was the position before under the Companies Act, then what was the position after the pipeline order, and what is the position after the MCA guideline which has come in. So I will discuss that in a little later, but it need not be the same. It can be different. But for the sake of convenience, we take it as, the appointed date and the valuation date. But having said that, it need not be said. There are n number of cases to substantiate that particular point. So some of the procedural aspect, if you want, I can delve. Otherwise, we can straight away get to that. So the main thing is yes, sir.
Ma'am, I have one doubt.
Yeah.
With respect to creditors,
yeah,
how to evaluate or the value of the creditors is arrived at? I think so 90% in value.
Value, yeah.
right, in value. So how do we arrive at, because creditor might tell that my the company is this much amount is due, X amount is due,
Yeah.
whereas company would tell no, only half of the X is due. So how do we arrive at that value?
Ma'am, creditors is one of the easiest thing to be valued in terms of valuation, in the sense you have a loan agreement or you have a debt agreement and you have your repayments. And to make your life little easy, the Schedule 3 amendment in Companies Act has given you the that is in terms of creditors, not in terms of in terms of creditors. The aging analysis is available from last year. You can look into that. But as far as you are concerned, the ideally speaking, year on year, when the audit process is happening, the auditor and the management is supposed to get a debt confirmation before the accounts are finalized. So if I finalize my audit, if there is a debt outstanding, I will take a confirmation state from the banks and financial institution. So whatever is my principal outstanding, you can take the ledger extract and find out what was the loan outstanding, how much has been repaid, and what is the closing balance. The dispute could be on the servicing cost, but that is also predetermined in your agreement. So
Okay.
this will be the least area of dispute. But having said that, there could be some areas wherein what you claim and what I agree may not be the case. In that case, your management representation letter is the only defense available to you. But having said that, management representation letter cannot absolve us of every problem, whether I be a statutory auditor or I be a valuer. We have to apply our due diligence and see this is what we have arrived at. So the entire valuation process is hovering upon one simple thing: what is the kind of due diligence we have applied? Because when we do valuation, when we talk about valuation, the valuations are definitely subjective. What you arrive and what I arrive may not be the same. But having said that, what what is the so you want the case law for the appointed date and effective date?
Yes, yes.
I will post it in the comment box. There are Humpty number, but I'll just give you one or two at the end of So it is available. So wherever there is, even in IBC for that matter, what you have in your books and what the your creditor gives you might be different. But having said that, we have to enforce our due diligence and see whatever we are arriving at is as per the books of accounts of the company, and it is in sync with what the organization is been claiming. So you have your basic documents. You are not going to do 100% audit on that, but you have to exercise certain amount of due diligence to get those numbers validated, because many a cases valuation done based on the audited accounts, wherein you have qualifications on caro, on say fixed assets, where you have qualifications on inventories, or where you have qualifications on say maybe a lot of contingent liabilities or liabilities which are not provided in the books in terms of statutory obligations. All those things have to be done. The audited accounts may not have considered it, or they have considered it, or they have put as a contingent liability. But as a valuer, we have to exercise our due diligence and see, and more so, it has to be documented in your documents. Major question is how, when there is a any authority questioning us, what kind of working papers. In fact, when I speak on NEFRA and all, I say it is more so to look at the documentation. So we might have done our due diligence, but it may not have been documented. So the documentation aspect of it, what is available with us. So you might arrive at a value of say 1 crore for a business. For the same business, I might arrive at 100 crores. But what are the assumptions in my calculation process? What is your assumption? And that is what is there in the valuation report. And some of them which are not there in the valuation report has to be there in our working file. If tomorrow is question, we are in a position to answer. So I hope that answers your question, that your due diligence on the existence and the credibility of the loan. Again, we say in our valuation report that we have relied on the management representation letter. In fact, I'm going to discuss on the RIL and RPL case, wherein, the Bombay High Court has dwelled upon that, just because the management has given certain projections or certain information wherein the valuer says, I have not confirmed those numbers, do not mean that there is a problem in the numbers. What the valuer is bringing to table is that I've relied on the representation, but we cannot rely blindly on the representation. We have to apply our due diligence. So some of the important procedural and approval processes, looking at the MOA, many a times forget about corporate restructuring. Even in normal scenario, when people are doing businesses, a company is operating, the activity for which they are operating is not covered under the MOA, the object clause. But so the MOA has to give you the power for amalgamation. But this is being tested in case of EITA India Limited, wherein the Calcutta High Court has said the power to amalgamate is a statutory power, notwithstanding the fact that the MOA does not contain express powers to amalgamate with another company. So you have to look at the MOA, but having said that, if it is not there in the MOA, EITA India Limited comes into rescue, saying that it's a statutory power. You don't have to have it in your memorandum to give you the power to amalgamate with any other company. So that it goes, you prepare the scheme, it goes to the board approves that. Then the valuation report comes in, the fairness opinion from merchant banker comes in. So our valuation report is going to be examined for the fairness opinion. So we have to be first mindful. The first level wherein our valuation report is going to be scrutinized is at the merchant banker level. Then it goes to the stock exchange, where the authorities are going to look at it, microscopic level. Then they give their NOCs, and then it goes to your shareholders and to the creditors. Again, your valuation report is under scrutiny, and finally it goes to NCLT. NCLT may not question your valuation report. There are n number of case laws. We are going to discuss 3-4 of them at the later part of the session. So if we have done our work with the deepest of sincerity, with applying our due diligence, then the law comes to our rescue. But many a cases, we will be dragged into the controversy of this approval of the amalgamation or any other compromise scheme, because they are challenging the scheme. As a process of the challenging the scheme, the first thing, or the one of those things will come to the challenging is our valuation report. So the valuation report may not be the real question of challenge, but as a process, because end of the day it is the money, and that our report will come to questioning in front of all the authorities. So the approval so the valuation report and the fairness opinion, in fact, valuation report and fairness opinion, in the case of RIL and RPL merger, one of the objections raised was the valuation report and the fairness report was signed on the same day. So, it was all done in haste, and hence, there was no without application of mind. Wherein Bombay High Court has said, okay, fairness of valuation report and fairness opinion could have come on the same day. It doesn't mean that, the valuation report is to be questioned. Fairness opinion could be given in a hurry, but that doesn't mean that there is no application of mind. So these are the smallest factors which would be questioned in terms of in front of various authority by various stakeholders for the compromise or the amalgamation procedures. So the approval at the board meeting of both the companies are there. Then the recommendation of the exchange ratio, which comes from our valuation report. Then the auditors will give a certificate on the accounting treatment, and the intimation is given to the stock exchange. Stock exchange has to give their no objection certificate. First they will make their opinion. They will suggest some modification. They will ask for clarification. They will question on the valuation. They will question on the scheme, and then they will give their recommendation to the board, SEBI. And within 7 days of getting approval from there, then the no objection certificate is given. And this no objection certificate which is given is valid for 6 months. So the prior approval from other sectoral regulators like RBI, CCI, telecom regulator, or IRDA comes into play. Then we file the petitions with the NCLT. The question is, should the transferee do or the transferor do? If it is in the same NCLT, both are in the same thing, and if one person is doing and attaching the other person, then there is no requirement to file 2 different petitions. Then passing of the directions by the tribunal for convening meeting, how the meeting to be conducted, who is the scrutinizer, where the newspaper, the advertisement has to be given. All these procedures are given. As I mentioned, if 90% of the creditors in value give their confirmation by an affidavit, the court can dispense the meeting of the creditors. But the meeting of the creditors can only be dispensed of. Meeting of the shareholders cannot be dispensed at any cost. So that meeting has to be conducted. And once it is there, the copy of the application is filed with the registrar within 30 days. Yeah. And then sending the notice of NCLT convent meeting of shareholders. So once the meeting direction has come, you say give it to the members. Then the way it is to be conducted. So the scheme is placed in the website of the company. It is sent to the members. Copy of the valuation report and fairness opinion is also being placed. It is subject to public scrutiny. So that we should be mindful of. Calling of holding of meetings, and then once the meeting is conducted, the chairman will submit his or her report, and the scrutinizer will send, and the report of the board of directors of the merging applicant companies explaining the effect of compromise of each class of shareholders, KMP, promoters and non-promoter shareholders, laying out particular change in the AGM or the EGM. The board of directors have to give a statement explaining the effect of the compromise or the merger for each class of people, including the managerial persons, KMP and promoters, and laying out the particulars in form of what is the exchange ratio and any other, if the period is more than what is filed, then you give your supplementary accounting statement if it is beyond 6 months and things like that. The notice of this meeting goes to, as I said, to all the people. So in some times, it will go to Competition Commission also. When Competition Commission comes into play, we will explain it in one of the slides little later. So then we file the report of the chairman of individual meetings. The RD could raise an objection. RD will generally raise an objection looking at the minority interest, looking at any of the contraventions and things like that. The opinion of registrar is also taken. So registrar gives us objections in form of, or looks the documents in form of whether the annual returns are filed, whether the documents are in order, whether they find any non-disclosure, misdisclosure, whether accounting standards have been fulfilled. These are the various thought process in which the different authorities looks at the documents before giving their opinion or the objection. Then we file the scheme of amalgamation and resolution with the registrar of companies. Then we obtain the sanction of NCLT. Then comes the payment of stamp duty. Why stamp duty? Is stamp duty legally applicable? We'll discuss in the next slide. Then we carry out the post-merger formalities with filing with the registrar of companies. Then there is a transfer of employees and things like that. All these things have to be done. Many a times, the process could have been smoothly done. But the challenge for the organization is post-merger, post-amalgamation, that there is no synergy, or the synergy what they expected is not coming in because there is no mind matching of the management or their employees or things like that. In case of Air India versus Indian Airlines, the pay parity between the people, that was one of them. So all those things have to be kept by the management before working out on the merger or an amalgamation scheme. Finally, the shares are issued and other consideration to the shareholders of the transferor company. So what are the issues to be considered? So before sanctioning a scheme, what are the, let me just look at, there are some questions in the chat box. Who can object for the valuation after the approval by shareholders? This is a precise question, asked in many of the cases. The courts have said that we will not get into the valuation aspects of it unless and until there are any fundamental errors in the valuation, or whether there is any a prejudicial interest to any of the shareholders or to the minority shareholder. If it is fairly okay, courts have repeatedly said we will not get into the commercial wisdom of the shareholders. So the objections will come from, as I said, from registrar saying that, maybe the annual returns are not filed, the documentation is not, or some questions are to be answered in the documents filed. from the RD saying, maybe there are some compounding pending with them, adjudication matter pending with them, so they can raise an objection. Stock exchange could raise an objection saying that whether this may not be fundamentally workable, or the company which has been loss making for ages suddenly comes up with the valuation report saying that we are going to turn into profit. This is precisely the my thought process in the mind of the stock exchange regulator. One of the gentlemen has shared his concern with me. So he asked us, how do you value? What is the premises you do? How suddenly a loss-making company is converted into profit-making? How is it all a way to give an escape to the organization? So these questions will be a question. NCLT also is not bound to accept the scheme the moment the shareholders approve. If they find the compromise or the arrangement or merger is made to defy any of the provisions of law. So lifting of corporate will or lifting of the intention behind that will also be done. Having said that, apart from that, they do not get into the commercial aspects of the valuation or into the compromise agreement or the merger agreement. Fairness opinion and valuation report, are they same? No, they are different. Valuation report is given by you and me as a registered valuer. Fairness opinion is given by the merchant banker based on the valuation report what we give. So the valuation report is the first scrutiny is going to happen at the fairness opinion level. So at that level, is there any not mind matching? So I bring in a report and merchant banker says, or the expert says that this is not as per this. So generally, when you prepare a valuation report, the good process could be to discuss with the expert on fairness opinion. May not be you will be sharing the final report at the instance, but you will be discussing this is thought process, this is what it is. Having said that, we have to keep in mind the confidentiality, the price sensitivity, and the other unpublished price sensitive information in mind. So we have come across the meeting of shareholders also. Is it valid, sir? The law does not give it because in one of the I don't remember the case law. They said only the creditors meeting can be dispensed if which NCLT which has given dispensed the meeting of shareholders. Could you specify that, sir? We need to check. But as far as I understand, meeting of shareholders will not be dispensed. Bangalore one. Okay, I need to check on that. But as per the provisions of law, only the creditors meeting can be dispensed. And then if it is done, I need to check on that. So issues considered by NCLT in the scheme of merger and amalgamation is, you asked me what all could be the objections. Is the compliance with the regulatory provisions being done? What is the rationale for merger or amalgamation? Is it done in the garb of putting a carpet on some misdeeds or some violation, or so is that the rationale? What are the provisions under the scheme for the protection of interest of creditors, shareholders, and employees and all other stakeholders? More and more, the work of NCLT will be dwelt upon whether the scheme is fair to all the stakeholders or not. We provided a few days, they agree, dispense both Amara. Okay. So maybe you would have given then 100% shareholders approval? Maithili ji, did you provide 100% shareholders? Yeah, okay. So then they would have felt, what is the need for it? So because in creditors, it's 90%. Whereas then in case of shareholders, by taking 100% approval by affidavit, the purpose of meeting is dispensed, but there is no explicit provision, but it might be coming as an implicit provision. So the provision under the scheme for the protection of interest of all your stakeholders. This is what is a major thing your NCLT is going to look at. This is what SEBI is going to look at, or this is what is your stock exchange going to look at. Whether the scheme provides for a fair treatment of all of the people in the scheme. Is it not in favor of promoters or any of specific interest group and not towards all of them? And whether the scheme is in consonance with public interest. This is the broad spectrum in which NCLT or any regulator is going to look at while giving their opinion or their approval for the scheme. So the next question is, So the next question is on appointed date and effective date. There's been a lot of confusion on this till the MCA circular which had come in. So there is no definition of appointed date under the erstwhile section 391 to 394 of the Companies Act 1956, or there is no definition in the Accounting Standard 14 also. It was discussed in Marshall and Sons and Company India Limited in the Supreme Court on the order dated 27th of November 96. It said every scheme of amalgamation has to necessarily provide a date with effect from which the amalgamation or transfer shall take place, because there has to be a date to give effect to any of the orders, right? It is open for the court to amend or modify the said date and prescribe such date of amalgamation as it thinks appropriate, looking at the facts and circumstance. So if there is no date or there is a date which needs to be modified or adjusted, the courts can do it. And if the court so specifies a date, there is a little doubt that such date would be a date of amalgamation. So if the court provides a date, that is your appointed date. It said it has to be a specific date and it can be antedated. So it can be backdated also, but it has to be a specific date. This was a discussion in Marshall's case. Under the Companies Act 2013, till 21st August 2019, the provision of law was that under 232(6), the scheme under this section shall clearly indicate an appointed date. So there is to be a date in the scheme from which it shall be effective, and the scheme shall be deemed to be effective from such date and not a date subsequent to the appointed date. So there has to be a date and the scheme will get effective from that particular date and not any date subsequent to that. This is what was the position till 21st August 2019. Ind AS 103 also do not define the term appointed date. It just says acquisition date as the date on which the acquirer obtains the control of the acquiring. This is what is said in the Ind AS 103. Mumbai NCLT in pipeline infrastructure order has dwelt upon this particular aspect of appointed date. It said, it is evident that a mandate under section 232(6) is that the scheme filed before the NCLT shall indicate an appointed date. So we are all sure there has to be a date in the scheme. It is not said day has to be indicated. It clearly indicated that date has to be indicated. It says it is to be a date. So it cannot be a day happening of some contingent event. And that shall be present in the scheme itself before filing before the tribunal. When it has to be specified as a date, it has to be conceived as a calendar date and it shall not be contingent upon approval of a scheme by NCLT. So in pipeline infrastructure case, the NCLT Mumbai said there has to be a date. You cannot give something which on happening of something my scheme will get into effect. So this is what they said. This cutoff date taken into consideration for valuation shall be appointed date. So here pipeline said the valuation date is the appointed date because all the financial implications are dependent upon the cutoff date and valuation thereof. There won't be any appointed date in future because the scheme is always dependent on the valuation, and for valuation of assets having to be done before presenting the scheme, it is inconceivable to visualize appointed date in future. This is what was said in NCLT order in pipeline case. This went to NCLAT and they said, this was overreaching effect. It said, it cannot be. But and then MCA came up with a circular in 21st August 2019, wherein it said the provision of section 232(6) of the Act enables that a company in question to choose and state in a scheme an appointed date. Here it said this date may be a specific calendar date or may be tied to an occurrence of an event. So my appointed date could be a calendar day. I put it in the scheme, or I can put a date saying that on receive of so-and-so approval, on receive of so-and-so sectoral, authority approval. So it says it might be tied to an occurrence of an event. So it can be a specific date, or it could be a date in future on occurrence of a specific event, such as a grant of license by a competent authority or fulfillment of any preconditions agreed upon by the parties, or meeting any other requirement as agreed between the parties, which is relevant to the scheme. The appointed date identified in the scheme shall be deemed to be the acquisition date. So the appointed date is the acquisition date for the purpose of Ind AS 103, for the purpose of accounting, for the purpose of business combination. So for the purpose of accounting, the appointed date is the date as the acquisition of business. Where the appointed date is chosen as a specific calendar date, it can be backdated also. It may precede the date of filing of the application for scheme of merger or amalgamation in the NCLT. So if I put an appointed date prior to certain time, it is also acceptable. The only condition they have put it, however, if the appointed date is significantly antedated, that is beyond 1 year from the date of filing, then you have to give a justification why you have gone that far. Till 1 year from the date of your submission is okay. 1 year backdated is okay. But beyond this, if you want to go, then the justifications for the same would have to be specifically brought out in the scheme, and it should not be against public interest. So the date we are choosing should not be in such a way, because the entire matter was discussed in the NCLT was that your appointed date was something. I think in that particular case, what discussed was July, and the valuation was done in November or January. He said between that period there are a lot of changes, and why we should consider July as the appointed date and why not January. So that is what NCLT discussed and said it should not be the case, and it striked off, it quashed the NCLT Mumbai's order. This scheme may identify the appointed date based upon a occurrence of a triggered event. That's what he said. It could be a license, it could be upon receipt of something, which is a key proposed in the scheme and agreed upon by the parties to the scheme. This event would have to be indicated in the scheme itself upon occurrence of it. So in the scheme, instead of saying 1st April 23 as the appointed day, I'll say the appointed date will be on receipt of so-and-so license from so-and-so authority, on transfer of so-and-so license from so-and-so authority. So the only condition attached to it is, so it will be on effective, will be the appointed date will be on occurrence of that event, and that will be the effective date. So appointed date, I think we are fairly very clear that appointed date is a date what we have said in the scheme, or the date which we have linked to a particular event in the scheme. So that's the appointed date. The only condition they said, however, in such event based date being subsequent to the date of filing, the order with the registrar under section 232(5), the company shall file an intimation of the same with the registrar within 30 days of coming into scheme. So if the scheme said on receipt of so-and-so license, on the day of receipt of so-and-so license is my appointed date, 30 days from the date of receipt of that license or the approval, we have to file with the registrar within 30 days, intimating that the incident has occurred and this is my appointed date. Now, in the matter of demerger among Century Textiles Industries Limited and Ultratech Cement, the order dated 3rd July, the petitioner company had determined, this is what I said, had determined the appointed date to be effective date in compliance with the Indian Accounting Standard Order 133 of the Companies Act. But the regional director took an objection that this is not should be the date, you should go with the certain so and so date. So the company agreed to that. So the petitioner of the company have assented to the amendment in the scheme and determined the appointed dates as 1st April 2019. Because they went with the date something in November, the regional director took an objection that your valuation was done as on 1st April and this should be your appointed date. The company agreed to that. The valuers have considered 20th May 2018 for the purpose of recommendation of share entitlement ratio for the proposed demerger scheme. Relying on the pipeline order, the tribunal held that the appointed date for the proposed scheme of demerger shall be fixed as 20th May, which is the date of valuation, instead of an arbitrary date of 1st April 2009 as they proposed in the scheme. But this was striked off. In Section 232(6) of Companies Act, the scheme under this section shall clearly indicate an appointed day, we said, from which it shall be effective, and the scheme shall be deemed to be effective from such date and not at a subsequent date to the appointed date. If there is a date, the scheme becomes effective from that particular appointed date and not from any other date later. The filing is only the date. See, and the law said you have to file the once you get an NCLT order, you have to file with the registrar. People thought from the date of filing only it's an effective date. There is no concept called effective date. On filing that agreement or the compromise agreement with the registrar, the scheme becomes effective from the appointed date. There is no specific effective date. The effective date is the appointed date, but you have to file it with the registrar. Only when you file the agreement or the arrangement becomes effective. but it is effective from the appointed date. I hope I put that clear to you. So NCI,
Ma'am,
yes, sir.
yeah. Just wanted to check, I mean, what happens on this appointed date? I mean, we say that the merger is effective means
Yes.
the old company dies off and the new company comes into existence if it is
Yeah.
and the books of accounts get closed of the old company, everything is transferred, thing comes. And
Yeah.
when it is contingent on an event, you're saying, correct?
Yes,
You
yes.
cannot file ROC unless those events happen. So how do you deal with that? I
No,
mean,
no.
if
Can
it is
you repeat your last part of the sentence? What do you mean by what did you mean in the last part of the sentence?
the last sentence is that you said that if I will get a license on that day, the appointed date will be there, correct?
Yes. Yeah.
In that situation, if that event has not occurred, so then the scheme will not be effective, correct?
Yeah,
You
because
cannot.
event is not, because what is the date you have mentioned in the scheme is not happened only. Your scheme cannot be enforced at all. Either the NC will not, LT will not pass, or after that it is a date, it will not go through now, because your event has not only occurred.
So the NCLT doesn't pass any order till such date happens, or we just say the order is passed and when the date happens, the scheme becomes effective. How
Yeah,
does
the
it practice?
effective date is from the date of the appointed date. If your appointed date has not occurred only,
Yes.
it is impossible to execute that scheme. See, if the effective, we are saying the appointed date is on receipt of certain license, you don't get that license at all. Then there is no
Yes.
scheme only. The scheme cannot be enforced at only.
So it
Right?
will be like order is passed, but the scheme is not effective or cannot be enforced. Correct? It will be in
Yeah,
abeyance.
that's true. That's true.
Okay.
In case of section 230 proposal during liquidation of IBC, should we take the creditor's value as per admitted claims or sir? It should be the admitted claims, because you again it is on your books of account, right? So what you have agreed, this is what will be enforced. So that will be as per the admitted claims. Hence, valuation date and appoint can vary beyond yes, ideally valuation date and appointed date can vary beyond a year, but you need to keep in mind, is there any substantial information or material changes are there, because of which it might be prejudicial to the interest of maybe your minority or to other shareholders or to the creditors. That is the responsibility of the management. But having said that, you are a valuer, I am a valuer, we have been asked to give a valuation report, we will give it and go. We may not be getting into that, but having said that, our valuation report may not be of use to them if it is going to be challenged. If the appointed date is linked to an event obtaining permit license, the valuation will vary significantly. Yes, sir. In that case, your valuation only is going to be done accordingly, no? With or without license. So when you are doing a valuation is always futuristic, unless until in a liquidation case you are going on the NAV value, right? So your valuation is going to be assuming that you're going to get the license. As I mentioned, if the license is not there only, the scheme is not going to go through. So your entire valuation is of just a theoretical paper, and it could not be used at all. Can you clarify difference between? Yes, sir. I will re-repeat what is the difference between appointed date and effective date. Appointed date is a date which is given in the scheme, which could be a specific date, and that date could be 1 year prior also, or it could be a date not mentioned, but says on achievement, on receipt of certain license, or on achievement of certain day, that date is the appointed date. So if I say the getting of a certain telecom license, say that my scheme is presented today, and I say in the scheme the appointed date is the date I receive the license from Telecom Authority. The day I get the Telecom Authority license, that is the appointed day for my particular scheme. If that is the appointed day and that is the effective date, only thing that date will come into effectiveness only when you file the scheme with the ROC. Before filing the scheme with the ROC, you cannot execute the scheme. So it says you have to file, but when you file with the registrar, that is the effective date is from the date of the appointed date. Your appointed date and effective date are one and the same. But the effectiveness of the scheme, it will not come into effect till you file the document. But doesn't mean that the effective date is going to be the day you file with the registrar. The day you file with the registrar, effective date is from the appointed day. The next slide that I put it much more clearly for you. Just give me a moment. I'll take you to the effective date. So in NCLT Mumbai pipeline case order, it says in section 232(6) of the Act, it is nowhere said that the effective date is a date when the scheme, this is the one I wanted to say. It is nowhere said that effective date is a date when the scheme approved has been filed before the NOC. Many people took the view that effective date is a date when you file the scheme with the registrar of companies. That's not the case. It is only said that the scheme will become effective from the appointed date with retrospective effect, because effectiveness to the scheme comes after the approval of the scheme is filed before the ROC. Say I filed the scheme in, say, November of 2023. The scheme gets effective date from the, if today is my appointed day, and I file the scheme with the registrar in, say, November 2023. In November 2023, the scheme becomes effective from today. So there is nothing called as effective date. Effective date is an appointed date. So therefore, there is no effective date. Only giving effect to the scheme from the appointed date alone is present. So
just to take your example a little more forward.
Yeah.
Assuming that the appointed date is September 1st, and
Yes.
we are actually filing the scheme with the ROC on November 30th, with
Correct.
the clause telling that it is actually subject to receiving the license.
No, in that case, your appointed date is, no. You will file it with registrar only when you get the license. The day you get the license, within 30 days, you will file with the registrar. In that case, your appointed date is the date you receive the approval from the authority, whichever is the authority.
Okay, let us assume that we have actually received the license on October 31st.
Yes.
Okay, and
That is
within
your
November
appointed
30th, we have actually filed. But we are saying appointed date is September 1st, or let us say April 1.
30, no, that is 31st October. That's the day you got it. Because in the scheme, okay, there are two ways to put it. I prepare a scheme today. I say the effective day, appointed date is today. Okay, today is the appointed date. Say 30th September is my appointed date put in the scheme. The appointed date is 30th September. The scheme is filed. Possibly I get the approval from NCLT, say in December, January. Within 30 days, I file it with the registrar. Say I file the scheme with the registrar on 31st of January. 31st of January is the day I filed the approval with the registrar. But my effective date is from 30th of September, which is the appointed day. 31st January is not my effective date. Effective date is 30th September only. But the scheme becomes effective from 31st January till you file the scheme. It is not coming into effect, but effective. So you can keep it this way. Your appointed date and effective date is one and the same. So if my scheme says today's 30th September is appointed date, that's an appointed date. If my scheme says my appointed date is the day I receive, say, telecom approval. So assume your telecom approval comes on 1st January 2024. That is your appointed date, not today. Because in the scheme, I have not mentioned any date. I said the appointed date is the day I get the approval from so-and-so authority. So the day I get that approval is the appointed day, and that is the effective day, but it comes into effect the day I file the scheme with the registrar. Is that now clear, ma'am?
Yes, ma'am, it is clear. Thank you.
Ma'am, little further.
Yeah.
Appointed date is 1st April 2022.
Yes.
Valuation date is also valuation date 31st March 2022.
Yeah.
Order we received on order pronounced on August. We received on say 15th September 23.
Yes.
So now in this case, the moment we file this INC 28, it will become an effective date.
Yeah. No, sir, that's not an effective date. Your effective date is still your appointed date of 1st April only. It becomes effective. So there is no effective date. Effective date and appointed date are one and the same. It
Yes,
comes
ma'am. Now,
agreed.
Now, there are certain compliances needs to be done post order, like allotment of shares, going for stamp duty adjudication, increase. There are many compliances under the Companies Act.
Yes.
So those are time bound, 3 months, 130 days.
Yeah.
All these things. What is the within how many? What is the triggering point to complete those formalities?
As soon as possible, whatever is specified in the respective act. If there is a timeline specified there, you do it. In many cases, you must have done all these things and your property may not have been mutated. So you might have a land mutation may not have happened for ages. So that is all your operational aspects, no? It has.
No, I'm talking about I'm talking about Companies Act requirements.
Companies Act, you're going to file the scheme within 30 days, and whatever is post scheme implementation procedures are given, you have to do within the time frame. Companies Act, if something is to be done, the time is mentioned already there in the act. So it talks about the entire thing. That's it.
But last point is now, at what point of time we have to merge transfer company accounts into the transfer company?
From
Is
your
it
appointed date, sir. From appointed date. That is why Ind AS 103 says the appointed date is the acquisition date. So what happens generally? You put a date as 1st April, so that the transferor company need not prepare one more set of accounts. Their audited accounts will be done on 31st March. So once the order comes from 1st April, their accounts will be merged, consolidated with the other company, or they are amalgamated. This company will not go for another set of audit. So generally, that's why people put 1st April as an appointed date, so that once the order comes, you don't have to prepare an account for a part of the period. Right?
Thank you. Thank you.
So then under section 233 talks about fast track merger. So fast track merger is for merger between two or more small companies. The definition of small company has to be kept in mind, or between a holding company and its only one subsidiary, or such other classes which may be prescribed. We can look at the rules for what other classes of companies are being prescribed. The benefits of fast track merger is that the approval of NCT is not required. It is less time consuming. It will help you in promoting your ease of business and reduce form filing. So if it's wholly owned subsidiary merging with the parent holding company, then it should not be subject to the entire scrutiny of calling this meeting, that meeting, filing this scheme and going for all those things. So they have given a fast track merger under the Companies Act 2013. The next aspect is stamp duty applicable on these order? Why so? If so, why so? Every instrument of transfer of property, whether movable or immovable, attracts stamp duty under the Stamp Act. So, for levy of stamp duty or for stamp duty on a conveyance, the necessary ingredients are what? There should be an instrument of transfer. The property, whether movable, immovable, should be transferred inter vivos between the parties. So your amalgamation approval or the order or the compromise order is an instrument of transfer, and it is between movable or it's a property, and hence stamp duty is applicable. In fact, this was a question tested in Hindustan Lever also, and one more famous, I just forget the case law. So it says they question the levy of stamp duty, and then many states like Maharashtra, Gujarat, Karnataka, they have already have included orders passed under 394 under the Companies Act under the definition of conveyance. So they have already modified the act. So there absolutely there is no question at all. So there is a stamp duty payable on these transactions. So in Hindustan Lever was the state of Maharashtra, it was held that the order of the court is an instrument constituting a transfer inter vivos, and therefore falls within the ambit of the definition conveyance, and hence stamp duty is applicable. I will not get into this one due to lack of time. 234 talks about merger and amalgamation of company with a foreign company. So now this is available to us. It is both the ways, between Indian company and a foreign company, and foreign company and Indian company. We have to look at the provisions of FEMA and then get the thing done. Then 235 talks about purchase of shares of a dissenting shareholders. Then 236 talks about purchase of minority holding by a majority, it is given there. And 237 gives a wider power to central government to provide for amalgamation of companies in public interest, which could be for, all your government companies when they want to get into an amalgamation. I just said one of the regulatory complaints need to be checked and checkmarked is Competition Commission. Should the scheme be filed with the Competition Commission? So the threshold limit for filing a notice with Competition Commission is, if at an enterprise level, in India level, they have 2,000 crores or more of assets, or 6,000 crores or more of turnover, and they have a worldwide worldwide activity with India leg of, worldwide is 1 billion with 1,000 crores in India leg, or in terms of turnover 3 billion worldwide and 3,000 crores in India level, then these schemes have to be presented to Competition Commission for their opinion. Or if this is at an enterprise level, at a group level, if there is an India turnover of 8,000 crores or above, or 8,000 crores of more assets, or 24,000 crores of more or turnover. And in case of worldwide, with India leg of more than 4 billion in terms of assets, with 1,000 crores in India, or in terms of turnover 12 billion worldwide with the India leg of 3,000 crores, then these cases have to be filed with the Competition Commission for their opinion and their concurrence for the scheme. When you look at Competition Commission, majorly they will look at the benefits or the blockages to the customer. So by doing this amalgamation, are they creating a monopoly wherein the customers are going to be challenged? So they will look it from that perspective and they'll give their comments. If they don't agree to them, then you have a roadblock in your corporate restructuring issues. Now let's get into as a valuer. I think we have overshot the time, but I'll try to do what best can be done. So valuation under compromise, we have section 230 talks about where valuation is required under 230 also, 232 also, 236 also. 230 talks about compromise arrangement with the creditor or debtor in case of a debt. Valuation of the assets of the company is required. In terms of merger of 2 or more unlisted companies or with a listed company. In case of listed company, SEBI regulations will come. Otherwise, your valuation has to be done on a standalone basis, and we are going to arrive at the exchange ratio required. In case of 236, if a member holding 75% or more shares in an unlisted company wants to acquire the shares of the remaining people, they can apply to NCLT, and they can purchase the minority shareholders under 236 based on the valuation provided by the registered valuer. So 232C talks about valuation report in respect of shares and properties and all assets. So it could be only a property, it could be a share, it could be everything. Depending on the what is involved in 232C, the valuation is done accordingly. In 232.2, it is always a valuation of shares of the company. The report of the expert with regard to valuation has to be given. So what is a valuation trigger point? In 232 and 233, the filing of the compromise or the arrangement amongst the creditors or shareholders is going to be filed. The trigger point for valuation is before filing the application. So the valuation has to be done before you file the application with NCLT. In case of 232, which is for amalgamation and mergers, the trigger point is before the board places their report to their members. So in the board meeting, the valuation report has to be placed under 232. So that is the valuation trigger point. In 232.3H, the exit for a dissenting shareholder. So a shareholder do not want to agree to this particular thing. You have to give an exit route to those shareholders. So where the transfer company is a listed company and the transferee company is an unlisted company, the transferee company shall remain an unlisted company till it becomes a listed company. So the transferee company will remain as an because here transfer is a listed and transferee is an unlisted. We talked about ICICI versus with ICICI Bank. So in this case, the transferee will remain as an unlisted till it becomes a listed company. If the shareholders of the transferor company decides to opt out of the transferee company, the provision shall be made for the payment of value of shares held by them and the other benefits in accordance with the predetermined price formula or after a valuation is made. So here valuation report becomes very crucial, and the arrangements under this provision shall be made by the tribunal, provided that the amount of payment or valuation under this clause for any share shall not be less than what is specified by the SEBI. In case of a listed company, SEBI gives you 26-week average, volume weighted average, 10 days, 60 days, 90 days. Those threshold limits have to be kept. Your valuation report will be done on that. That is a bare minimum price we have to give for the purpose of to the shareholders. So valuation is again required under Ind AS 103. When is it required? It's required at the time of acquisition, which is nothing but your appointed date. So it's for the business combination and it is for the accounting for the business combination. The difference between this and a slump sale is, in a slump sale, in merger, you have the valuation. And then, for various assets, you're going to allocate the values for the assets and liabilities and account it. We generally do it in pooling of method. In case of in case of slump sale, there is no value assigned to any of the assets or liability. Lump sum values arrived at. And then the exercise of assigning value to the assets and liabilities is going to be done. That's a different task altogether. So 234 talks about amalgamation of cross-border amalgamation between Indian company and foreign company and vice versa. There also valuation report is required, and the requirement is depending on which act you are doing, because different act says different kind of valuation. Companies Act talks about registered valuer, income tax talks about chartered accountant or a merchant banker. FEMA talks about merchant banker, internationally accepted valuation rules, or a chartered accountant, or in some cases cost accountant also. So in case of 236 2, purchase of minority holding, the acquirer or a person or group of persons under subsection 1 shall offer to the minority shareholders of a company for buying the equity share held by such shareholder, again at a price determined by the valuation of a registered valuer. So that's what I said. Under Companies Act, if you leave alone private placement and for section 42 and 62, the major chunk of valuation requirement comes under your entire chapter 15, that is 232 to 240. So valuation trigger point under 236 is acquisition of minority stake by those holding majority, that is 90% or more. When is the valuation trigger point? Before making an offer for buyout of the shares from the minority holder. So the valuation trigger point is before making an offer to the shareholder, the valuation has to be done. So this is as far as company law is concerned.
No, most likely not.
Can you clarify accounting under Ind AS 103?
Yes, dear.
Holding method or acquisition method?
Yeah, I've got a new flask, Kanaka. I can, depending on what you want, I can get you.
Sir, under pooling of
Madam, I have a doubt.
Yeah, yes, ma'am.
With respect to demerger,
Yeah.
okay, what happens is, suppose there is a valuation of a company and we have to value the unit which is being hived off, the demerged.
Correct,
Okay.
correct.
So when I'm valuing the company, what should be the assumption that this particular unit is not existing, or the way it is now presently, the whole unit as a whole, how the valuation of the company has to be arrived at?
So you have a company, the full unit, wherein you have done a valuation for it based on whatever method you choose, if it's a listed company based on that. And the challenge will come to you. You will not be able to ascertain a value from that for the particular unit. For that particular unit, you can use any of the other the valuation methods. You can use your DCF. You can use a comparable comparison, maybe a similar unit, the one which are going to demerge. Maybe there is a listed peer in the market, or there is a comparable transaction in the market. Then you can benchmark it and do it, or you go by your earnings other approach. What is the earnings from that? Generally, when you do your segmental accounting, you'll have some values attributed to that. You have your top line, you have your bottom line. So maybe you can do an earnings capitalization. So from the total value, you remove this value is the value of the other company, which is after the demerger. So you can use whatever suits you. You can do a multiple of those method and find out a range of values. Maybe you can give weightages accordingly and decide on the value for that.
And this particular unit, how do I apportion the expense? Because if I'm a part of an organization, lot of admin is already taken care by the finance, and a very small amount of that whole overheads is attributed to this unit. But if this unit is a separate company, all of the overhead expenses maybe majorly it could be repeated.
Pertaining to them. So if it's working as an individual profit center, then you have the P&L for that. The challenge will come. You may not have run it as a standalone unit, but when you're talking about such unit, then you should get the ways. You have to go back to your costing basics. So how to ascertain your fixed cost, to how to allocate them, how to apportion the overheads, and then arrive at a value. Then maybe you do a projected value for the next few years, then discount it and bring it back. Or I have a listed peer for the same kind of unit. Say I have, caustic soda baking a unit, which is a part of the major unit. What are the listed peers in the market for the caustic soda unit, which can be compared with this? And then I can look at their EBITDA, I can look at their EPS, I can look at their, and then I can do it. So you have to have multiple ways of finding out the value. So different set of valuation will throw out different series of values. Then you can ascertain weightages to each of them and combine it, or you can choose one which is more appropriate or more suitable than what is applicable in your particular case. So it is all, as a valuer, your judgment. And if your judgment is based on sound logic and it is there, that is where I said, when you go to the court of law also, they will say, yes, valuation is a subjective exercise. It's precisely an art. It's not a science. So far, I'm able to justify what I have done. I've done things as per the requirement of the valuation standards, as per the requirement of the industry standards. Then my valuation is cannot be questioned. So unless until there is a fundamental flaw in the my assumptions, presumptions, and the valuation basis we are applied for. So that's the only way. You have to do permutations and combinations and ascertain your value. That is where our judgment call will come into play, right? So requirement of valuation under SEBI, we have LODR talking about the valuation requirement. We have the ICDR requirement talking about the valuation requirements. And we have, SEBI substantial acquisition of shares and takeover regulations also. I will not discuss each of them in detail, but let me take you through the major regulation. Under LODR, regulation 11 talks about the listed entity as to ensure that the scheme of arrangement does not, or which is presented to the tribunal, does not violate or override the limit of provisions of securities and exchange requirements of law. So which talks about basically the pricing should be as given under maybe SAST or under ICDR. So regulation 37 talks about, without prejudice to provision of regulation 11, the listed entity desirous of undertaking a scheme under arrangement or involved in a scheme of arrangement shall file the draft scheme of arrangement proposed to be filed to the tribunal to the stock exchange for obtaining their observation letter or no objection letter before filing such claim. So I said the first scrutiny is with a fairness report. Second scrutiny with the stock exchange, looking at your report, and then they will give us this. They will look at the scheme. They will look at the valuation. They will look holistically, and they make their observation and ask you to make some amendments. If once the amendments are made, they will give their no object. They will report it to the board, and then take their opinion. And within 7 days, they will issue us a no objection certificate. That certificate is valid for 6 months. So what is the valuation trigger point here in terms of not corporate restructuring, in terms of preferential issue? Regulation 158 talks about preferential issue for conversion of debt into equity and strategic debt restructuring. The trigger point is at the time of determination of conversion price in case of conversion of debt into equity under the strategic debt restructuring. So the trigger point is at the time of conversion. If the debt is going to be converted into equity, at that point in time, valuation is required. Again, it says, the valuation is done by a valuation report by an independent registered valuer, and the stock exchange is not, if this is the real crux of it. Under 198, they are saying, if the stock exchange is not satisfied with the appropriateness of the valuation, it may get valuation done by another valuer, and for this purpose, it may seek information as may be deemed necessary. So fairness opinion done, stock exchange looking at that, they find the valuation report is not fair, they might go for another valuation report, and maybe our valuation report is challenged. So our basic fundamental premises, our hypothesis should be there to defend our opinion on the value. So in case of preferential value, what is the price? It's given, before it was 26 week, on 2 week average price. Now it is called volume weighted average price. So volume into price, and then you get the weighted average for 90 days and 10 trading days. It should be higher of the thing. For calculation of 90 or 10 trading days, formula is given under SEBI FAQ under SAST regulation, which can be used. Again, it says, if your AOA provide for a method, use that pricing price if higher than ICDR pricing. So there is a pricing guidelines given under ICDR, but if your articles of association provide for a better valuation, then we have to use it. So the first thing we need to check in the articles of association is whether there are any pricing methodology given there. And our valuation report has to delve this particular clause very clearly in your valuation report, whether is there any AOA provided method, and if not, then we say there is no AOA provided method, and hence we have used the ICDR pricing method, and this is the value arrived at. Again, it says if there is a change in control by more than 5% dilution, valuation report is required from a registered valuer. So in case of a substantial acquisition of shares and takeovers regulation, the regulation which talks about is regulation 333, delisting of equity shares of a company by a recognized stock exchange. What is the activity? Determination of the fair value of the delisted equity shares. In case of equity shares are delisted by the recognized stock exchanges, the trigger point for valuation is at the time of delisting of equity shares of the company by stock exchange. In case of infrequently traded, so that is given under regulation 165 of SAST. The activities, how to do a pricing of an infrequently traded shares. First, it defines what is an infrequently traded shares. In such cases, how to do valuation. And there are ways and methods given under that regulation. So before doing a valuation under SEBI, we have to go to the respective, we have to go through the entire LODR, we have to go through the ICDR and the SAST or the delisting regulation and find out what are the guidelines given there, and then look into any FAQs if anything else is given beyond that. All these things, it's like reading a FEMA. Read all of them together and then prepare your valuation report. So the trigger point is at the time of pricing of shares of an issuer which are not frequently traded in line with the requirements as given under regulation 165 of SEBI ICDR. So what is given there? The offer price shall be highest payment negotiated under the share purchase agreement or under the public offer. Volume weighted average price in the past 52 weeks. Volume weighted average price in the past 22 weeks. Volume weighted average price for last 60 days traded on this exchange. Here we have to pick up the exchange where our shares are traded more than 10% of the total value. So that calculation has to be a part of your annexure. So if you have how you have arrived at an exchange, so you have two exchanges, say NSE, BSE, the trading volumes there, where it is traded more than 10%, then I pick up there. Then we go to calculation of volume weighted average price for the last 52 weeks, 26 days, 26 weeks, 60 days, and negotiated, have annexures for ease of this calculation. So the summary or the table summarizing the value can refer to each of those annexures as the calculation sheet, which is made as a part of the calculation of the valuation report. Where the shares are not frequently traded, along with these four methods, you have the fifth one also. If none of these things are applicable to you, the price determined by the acquirer and the manager to open offer, taking into account valuation parameters including book value, comparable trading multiples, and such other parameters are customary for valuation of such shares. So in case of frequently traded shares, if none of these things work, I go to, or if I have these numbers, plus I do my valuation based on my traditional way of valuation of an unlisted company, and the price will be the highest of all these five. So along with these, volume weighted average calculation, we will do our traditional method, maybe DCF method, maybe book value, maybe market comparison, or all of them put together and arrive at the value, and the value to be picked up is the highest of any of these prices. So that is in case of unlisted shares. Compromised restructuring, valuation of shares and brand, the assets worth the enterprise of a property. So in merger, amalgamation, demerger, or acquisition, valuation is to fix the shares to be exchanged. The entire exercise of a valuation is for the purpose of fixing the exchange rate. When in case of amalgamation and this thing, demerger, where the mirror image is there, the valuation is relatively easy because there is no undue advantages. You don't have to look at the synergies. Maybe you can do with the existing, in case of SEBI, with the guidelines. Plus you can do your other methods, DCF or NAV, depending on what is the requirement and what suits you. Maybe weighted weights could be assigned to each of them, and you arrive at a value as possible, right? So now this is all from the legal perspective, from the law perspective in terms of corporate restructuring. Then comes our traditional way of valuation, which we are all very sure. So that is why I didn't I concentrated more on the law side, where valuation is whether you are going to do a business valuation, equity, tangible. If it's going to be for restructuring of particular loan, then what is that asset value that is to be valued? Again, price is what we pay, value is what we get. So value could be a participant specific value. Value I attribute to a asset may not be same as the value you attribute to the asset. So all these expectations have to be appraised. Value of a company, again, between value for a company having a strategic buyer is different for a value for a financial buyer. Between a person who wants to acquire 51% more, the value for them could be very different than a person who is just acquiring last 5-6%. If he has got already 96% and or maybe 90% to achieve next 10%, it is only for consolidation purpose. So they may not attribute a greater premium to that because they already have their 51% for passing ordinary resolution, 75% for passing a special resolution, and 90% for minority protection. So maybe for the last 4-5%, they will attribute a different value. So when we look at the valuation concept, we all know valuation is not a science but an art. It's a subjective valuation. It varies from time to time, situation to situation, participant to participant, and the value is date specific. So the valuation achieved today may not be same as value achieved 2 months down the line or value derived 2 months ago. The trend of the valuation is as good as the assumptions we make. It is to be free from bias, though we might want to free it from bias. Many a case the valuer's bias is seen in the valuation report. That is what to be eliminated. And for mergers and demerger, relative valuation on a standalone basis, as is where basis required, not again, valuation is not a specific value we are going to arrive at. It is going to be a relative valuation. So it is the normal step what we do in any other valuation. We obtain the basic information, we discuss with the management, we look at the industry overview, we look at the data given, we review. In fact, in terms of if you are doing NAV valuation, we have to look at the qualifications under CARO about the fixed assets, of the inventories, what are the procedures in place, test for their impairment. You may not be doing all of them, but you have to do your due diligence. The audited accounts cannot be blindly taken. The audit report itself has to be read with a pinch of salt, saying that it is a reasonable assurance, and if there are inbuilt frauds, then the audit exercise may not be able to capture them. So with that pinch of salt, we have to read the numbers and then apply our due diligence, select the method. Sometimes one particular method will work in case of listed company if SEBI valuation is given, or sometimes along with that you have to have other combination method, maybe apply weightages to them and arrive at a value, or you arrive at one value depending on. But in the valuation report, we are going to discuss about all the aspects of valuation, all the different methods of valuation, why it is considered, what is the value arrived at, and finally what is the conclusion we are going to make out of that. And again, on the assumptions, we have to do a sensitivity analysis on the numbers. We can assign weights to them. Then we are going to recommend a number. It is only a relative number and not a dotted line number that it is a final one. The same valuation, if you have done and I have done, there could be n number of differences. But those differences might be depending on our understanding of the business, our expectation in the business, our WACC applied, your WACC applied. So it could all be different. So end of the day, whatever assumptions, presumptions, and the premises we have made, we should be able to justify, and it should be there in our working file. So we are going to report it in this format as given under the IVS or CA Institute valuation standards. And the report is going to be with all your caveat and disclaimers. We should try to avoid giving too many disclaimers, give as much as only required, because end of the day, if too many disclaimers are given, and it should not work against us. So we collect information from various historical data, such as audited accounts, from industry expert, analysis, future projections, stock market quotations, discussions with the management, representation by the management, but it cannot be blindly taken. You have to apply your due diligence. Again, I'd say data of comparable companies, how we are looking at the comparable companies. Are they on par with us, or if they are above us in certain terms, then what discounting factors, or what what do you call level playing effect we are going to give. Look at the market surveys, newspaper research, industry research report. what is the future for that industry globally, locally, what are the growth factors, so all these aspects, as we do in any other valuation, will come into play. A fundamental analysis, we look at the industry, SWOT analysis, management composition strength, profitability, because management composition strength is very important in case of mergers and amalgamation, or in acquisition, because the acquirer could have a better management strength, and because of that, the acquiring company could get it. So what is the synergy they are going to get in? Who is bringing in the synergy? What is a standalone value of both the organization? Put together, what is the value? So the difference between the total value, that combined value minus the individual value, is your synergy effect. So what is the synergy effect? Look at the profitability analysis, profitability ratios, quick ratios, activity ratio, turnover ratios. All these things are given under the new companies at Schedule 3 format. So from last year, we have all those ratios there. Whether the ratios are applied properly, maybe we can do some testing and pick up those ratios for your calculation. So basis of valuation, type of valuation used, valuation is always a purpose-driven valuation. So depending on the purpose, the valuation workings will different. Different bases will lead to different values of valuation. Fair value is taken only when the reasonable buyer and seller is expected to buy, and in fair market value, it is of what do you call fair values and exit value. Basically, fair market value is between two knowledgeable buyers without any compulsion they buy. So what is a participant specific value? In case of all your corporate restructuring, this liquidation value may not work, because we are going a concern basis. So what is the synergetic value? So I said, the total value of the group minus whatever is the individual values is a synergy value. So what is that? What is regulation specific value? In case of non-financial asset, highest and best use is to be used going concern, as is where basis, orderly liquidation, forced liquidation. So in case of valuation, in 90% of the case, in case of corporate restructure, your going concern will only be used. We have discussed about the appointed date, effective date very clearly, because this is the cutoff date for the purpose of accounting in the books. Maybe your valuation date is different from your appointed date, but we need to understand what is the appointed date, what is going to be there in the scheme. Again, in terms of valuation, if you have level 1 inputs, then that should be used very effectively compared to level 2 and level 3 inputs. Level 1 inputs are quoted market prices, unadjusted. In that case of level 1 inputs, I don't have to add control premium. I don't have to do any discounting. I pick up that value. In case of level 2, it is not level 1, but they are still observable inputs in terms of assets and liabilities. In terms of level 3, they are non-observable. So we work with the DCF and data presented by the management, subject to our application of due diligence on those numbers. So what are the various methods? In case of market approach, we use market price method, market comparable method. In terms of earnings price, we'll do discounted cash flow, earnings multiple method. Cost method can be used in some cases where net asset method can be used, or replacement or realizable value can be done. The advantage of using cost market approaches, it's easy to understand and explain. It is easy for us to calculate it also, because the data is available. Benchmark can be done with the industry. These are level 1 inputs, so it is more justifiable numbers. The challenge is market numbers are always subject to market distortions, maybe a temporary gap. Temporary ups and downs. That is why they say 26 weeks, 10 weeks, 90 days and things like that. But having said that, if you are in a certain phase of economic situation, then those market numbers could be distorted. So market value is subject to market distortion, and it's a relative valuation. In case of valuation can never be a single number achieved at any point in time. It is always a relative valuation. In case of market approach, we can use market value method, or we can use a comparable companies method. So I can look at the maybe the industry PE. We can look at the peers there. I can apply my EBITDA and into the multiples possible. I can apply my PE possible. So I can use a comparable company method. If there are no comparable companies peers in the stock exchange, then I can. Yes, ma'am.
I have a query.
Yeah.
When we are using comparable companies multiple method,
yeah.
Okay, is it mandatory that I mention the name of the comparable companies? Can I just say that I have done a comparable in my working papers, everything is there, but in my report, I'm just giving the multiple. Is this fine?
It's possible. No, you can substantiate if need be the case.
I can.
No,
Yes.
it is there. You can give it. The challenge is when you put those companies, then you are subject to more scrutiny. But yes, you can do it. Put it also, not put it also. It's
Yes, madam, you got my point. If I put it, I will drag more scrutiny. At a glance, it will catch.
But that is where I said even it is but apparent. But having said that, if it comes to scrutiny, you should have because the choosing of the peers itself is an art.
Yes,
Because the
yes.
peer you're going to look at, the peers should not be up in the value chain or totally down in the value chain. If they are, then you have to do this adjustment to bring on comparison. So then you can use the comparable transactions multiple method, wherein you can look at the historical other comparable transaction which has happened in the recent times, or prior sales method of business, that can be used.
Yeah, this is always a challenge, because if we say that there is nothing, then again we are bad. If we say yes, something is comparable, they'll question how is it comparable?
How is it comparable? How you convince yourself that it is a comparable? This thing is what something we need to do.
What softwares you use, madam?
Madam, there are lots of software. You can use whatever you want. In fact, many cases while doing transfer pricing only, we get a lot of information from stock market. Only we get the information. So what you use, again, specific to what you are looking at. You need to look at, and sometimes it so happens that you might have to benchmark with even in the global standards, the companies and bring tinkering to the local requirement and do it, depending on what is the need and what you're trying to achieve. You need to look at those things. So you can do a sales to multiples, you can do a EBITDA multiples, you can do profit to earnings ratio, you can do a price to book, or you can do a cash flow to earnings value. So enterprise value to sale and price to earning are the common multiple used in the computation. So you arrive at a mean, median, and range and compute multiple values, and then you pinpoint what value you are looking at. The advantage of using comparable company analysis is provide a sound approximation of value. So it's a relative comparison. Data is available to you. Estimates the value are derived from the market or not based on your assumption. So that is one advantage. When you use market multiples, it is always market driven data. You have some peers to compare and you use that accordingly. It is difficult, but the challenge is it's very difficult to find a peer for you. The method yields an estimate fair training price. Then market price is always subject to sensitivity. You might have a better management, or you might have some better strength compared to them. So possibly we need to give adjustment to that. But when you do level 1 input, then you don't do addition to your what do you call control premium or this thing. So comparable transaction analysis is same as comparable company analysis, except the valuation multiples from historical acquisitions of similar entity. Here we don't include a takeover premium, as it includes a historical value. So the advantage of comparable transaction analysis is derived from a historical transaction prices. No need to do estimate a control or a takeover premium. Again, difficult to find historical data, subject to price distortion and things like that. Cost approach, I'm not getting detailed into that. We have a book value method, replacement method, excess earning method. We can use it either of them, all of them, and see what works best for us. Earnings approach, again, when we are looking at discounted cash flow method, we are going to look at, are we going to look at FE, FF, then WACC is to be used. If it is FC, FE, then CO is to be used. Terminal value is to be done. What is the terminal growth rate we are going to look at? What is the risk-free return we are going to look at? What is the beta we are going to pick up for that? And what is the decision on sharing the control premium? All these things have to be analyzed. So doing back calculation, maybe we can do it as PE to earnings multiples. So that is another easy way to calculate. If you have both PE and EPS with you, you can compare with the industry and get the valuation done. End of the day, the entire exercise is done to arrive at the share exchange price. So the transferor share price divided by the transferee share price will give you the exchange ratio. the ratio should not be detrimental or disadvantageous to the small shareholders, to the public shareholders, to the other list of creditors and people. So that needs to be kept in mind. Valuation of super profit is can be done. Valuation is tangible assets plus the price of maintainable future profits minus your normalized return on the return, minus that is the super profit. So it can be done on capital cover yield and any of these methods. Finally, we arrive at a method of we use different methods. It throws a range of values. Considering the type of methodology the value comes in, depending on the purpose and the premise used for valuation, we pick up that valuation. We can do a mathematical weightage. You can reach at a conclusion, and it is a professional judgment, and it is subject to maybe a judgmental error, but the efforts to be done to ensure that the judgment is done professionally and done on sound logical premises, and the value arrived at subjective. So the same company, you could arrive at a different number, I could arrive at a different number. Both of us could be right. How we have justified our calculation is what end of the day matters. So challenges in M&A, minority interest versus promoter interest, market value, because market value is always done on a herd mentality. So that is to be done. If you are doing other kind of valuation, don't just look at the numbers, look at the BRSR reporting. What is their strength? What is their S factors? What is their G factors? Do they give any credibility to the numbers they are going to generate? Generally, when we do valuation, either it is too conservative or too aspirational. It has to be in between both of them. We have to look at the quality of the management, their strength and their estimation, how best they will be able to deliver the result. Too much dependence on intangibles and no effect on the no effect to the intangibles. That needs to be, whether you depend to in a startup valuation, we look too much on the intangibles, or we don't give it at all. So depending on what we are doing, why we are doing, stress on the story, tag-led, corporate governance, ESG, and cash flows. If we have 5 minutes, we'll quickly go through 3 of the case laws. I'll just summarize it for you. Entire valuation exercise, what kind of scrutiny comes in, can be understood. There is a book published by CA Institute on case laws and valuation. If you can go through that, you get a lot of inputs as to what we should be doing and what we should not be doing while doing valuation. So Mihir Mafatlal as a classic case law, from examination time we have been studying. So the voidability of a scheme will be judged subject to the rider. Majority has decided. So majority has decided means it's a commercial decision. It should be binding on the dissenting majority, provided the minority is not put to a disadvantage by doing a colorable defense. Otherwise, the court will not sit on the value judgment of company. Scheme of compromise and arrangement to lawful and just and fair to be the whole class of creditors or members, including the dissenting majority. If this fair and just is being taken care, the entire valuation exercise will go smoothly. Commercial wisdom of majority of creditors and members to be trusted, and court will not sit on the judgment over their decisions. Court has neither the expertise, these are the observations of the apex court, neither the expertise nor jurisdiction to delve deep into the commercial wisdom exercised by the creditors and members. The court says, court will just act as an umpire, and it will not overstep its limit. It has got no oversight over there. The proposed scheme of compromise or arrangement is not found to be in violation of any provisions of law. And if it is not contrary to public policy, the court will always sanction those, the compromises and their arrangements. For ascertaining the real purpose, just like lifting your corporate wheel, the court can pierce through the wheel of apparent corporate purpose, underlying why the scheme, and judiciously x-ray the scheme. So we have to have this in mind, that the court can get into the depth of the transaction to find out whether it is done to defy any other authority or to avoid any provisions of law. So the court has said it cannot refuse to sanction such a scheme on the ground as it amounts to otherwise court exercising an appellate jurisdiction over the scheme rather than its supervisory jurisdiction. If 95% of your shareholders and are given their opinion, court says, who are we to sit on their best judgment, and interfere in their matter? This is very important. A court does not exercise appellate jurisdiction. it exercises jurisdiction found on fairness. That is what is a deciding principal condition for us to arrive at the figure. It is not required to be interfere only because a figure arrived at by a valuer was not better as it would have been if another method would have been adopted. So just because I adopt a method and you adopt a different method, my valuation need not be thrown and yours can be taken. What is imperative is that such determination should not have any contrary to law, and that is not unfair to the shareholders of the company. That is the finally deciding criterion. In case of Hindustan Lever employees versus Hindustan Lever Limited, the base of valuation is also given in the apex order. Dividend presently paid on the shares of the company, relevant growth prospects of two companies, the cover ratio of after-tax earnings of dividends paid during the year, for payment of a dividend of two companies, relative gearing of shares of two companies, value of net assets of two companies, voting strength in the merged enterprises, past history. All these things can be taken and done in deciding a share ratio, and that is what is given in the thing. It is not required to interfere only because a figure arrived by the valuer was not as better as it would have been. Another method would have been what is said in the previous case is stressed upon here. Again, it says if 41% of shares held by a financial institution has given consent and not found any fault in the valuation, it says the court should not get into that valuation numbers. Let's look at Sultania case again. Here it says if 75% of the shareholder holding 75% have given their consent, then the court should not get into that valuation discussion. It may not suit its objective to pay a higher price than the other pay. So the last but not the least case I wanted to disclose here was the aspects what people consider when looking at our valuation report. I just want to highlight these points and conclude it. I think I overshot my time. In case of Reliance Petroleum with Reliance Industries, the matter was considered in Bombay High Court had considered matters like, the scheme was, was a transferee with 75% holding by RPL. The scheme was approved by majority of the shareholders and unanimously by secured and unsecured creditors. Even RD and ROC had given the objection, their consent. But the objection was raised by few people. What was the objection? The valuation report was given in haste. It was done over a weekend. The valuer gave a report in 2 days, and the fairness opinion was given on the same day. The board resolution was passed on the same day. So it said everything was done in haste and non-application of mind by the board and the valuers. The court opined that by doing the same, all of them on the same day, does not mean any non-application of mind. When you go through the valuation report and the fairness report, the report considers all the aspects of valuation before arriving at a swap value, a swap ratio. The valuers have considered all the three methods of valuation: NAV, CCM on EV versus EBITDA, volume to weighted average price for market price. Everything was considered. There was no flaws as such found in the valuation report, or there was no any compelling reason to reject the scheme or to reject the valuation. Clause by clause reading, then the one of the objection raised was clause by clause reading of the valuation report gave an opinion that the valuers were dependent on the management representation letters, and those were not validated by them. And court said we don't find any contrary to prove what the management has said. So they said no flaws notice, though the language says experts do not take responsibility for the projection. So in the valuation report, we say we do not take responsibility for the projection. Do not necessarily mean that we have to discount the projections or we have to do 100% checking on those numbers. So far, the projection is given by the management, and you don't find anything contradictory to that as a common valuer would do. Then you can give your opinion on that. This is a conclusion of the Bombay High Court. No one has doubted the integrity and honesty of the valuers who was given their share valuation report or fair, nor the object being able to point out the method adopted by the valuers were permissible or absurd. Therefore, there was no reason to discuss the valuation of share or the swap ratio determined by the expert. when you kept it for the over the value judgments who are supposed to. So all these judgments come to our rescue at the end of the day to say if you have done a good job and we are able to justify our numbers, then we should not be apprehensive about that. There are some questions. Let me quickly take up what are the common queries they say? Okay, this we have already done. Difference between level 1 and level 2 inputs. It's a level 1 inputs are the market driven inputs where you can see and you can validate it. Level 2 inputs are not level 1 inputs, but they are still observable. Level 3 is your projections and things like that where you don't have an observable information. So level 2 is observable, but not fully observable inputs, you know. Okay. Thank you so much. I think I've done with the questions. If you have any questions, we can take it. I'm very sorry I've overtaken your time, though I tried to cover as quick as possible. Sorry.
Yeah, actually, most of the questions. Yeah, go ahead.
Yeah. Ma'am, Shilpa, can I proceed?
Actually, any question, one more question we can take from the audience. One last question. Actually, most of it the speaker has already addressed. Yeah, because of considering the time, we would like to conclude the session. And I request Mr. Chandrasekhar to extend vote of thanks on behalf of BVA for today's speaker.
Thank you, Shilpa. Madam, very good morning. I think the session, the excellent session it is. I think this is one of the best session. This is a valuation. Normally, we look at the from a valuation point of view from one side. But today, this is you covered NCLT process, appointed date, this effective date, Companies Act requirements, income tax, and so many factors. I think I can say within 2 hours. It's like a Shatabdi morning. We are not trying to look back here and there. I'm thinking that something I miss. So it is excellent, very excellent session. I, on behalf of the BBA, extend warmful
Sir, I came
thanks
very
to you
nervous.
and also for very good time.
I came very nervous to your session. You know, valuation is not my routine area of delivery. You know, I speak on other subjects. So when sir called me, you know, Sivaprasad sir said, "Sir, this is one area I shy away from speaking." You know, and you're asking me. He said, "No, madam, you come and do it." You know, thank you so much.
No, madam, I think, madam, we are not finding. So we are thinking this is one of our best sessions in our BBA excellent sessions. And I also suggest to our BBA managing committee, such sessions you can have some sort of a panel discussion so that some of the most of the questions can be clarified. And thank you, madam. And on behalf of our BBA, would like to acknowledge your excellent support, and we offer this memento. Vijay, just can you share this?
Yes, actually, the memento will be couriered to you, madam. Our admin Vijaya will be in touch with you.
Thank you
And
so
I
much.
extend thanks for Mr. Shivprasad, who has connected BVA to today's speaker.
Thank you very much.
Madam, people are in the group, they're requesting whether PPT is possible, you can share.
I will give it, sir. I will give it to Vijaya, madam. You can take it. I will just convert it into PDF and send it across to you. Thank you so much.
Thank you, BVA, for organizing an excellent session, and Mr. TVS Prasad, thanks a lot.
Thank you, sir.
Good morning, madam. I understand that you are not a member of the BVA. I request you to join BVA as a member.
The more than
So
happy
that
to join. Our
we can
problem
be more benefited from your knowledge.
we are not
Thank you.
able to do our necessary credit hours everywhere. That is our problem. My IP certificate is not renewed because I don't have my enough credits with me for the last 2 years. You know, sparing time for these activities is difficult. I definitely will join you, sir. Thank you so much. Yeah.
Yes, from the next month onwards, we'll be having probably some discount on the membership fees, which Shilpa will be explaining,
Yes,
so that please use that advantage and become a member.
what a wonderful session in the morning, 7:30. You have 20 odd participants joining only on valuation topic.
No,
you know.
actually,
And the
initially-
participants were more than
was
40.
up to 42.
Initially 42, but now 9:30, no? Some people have other assignments.
Yes, sir. Thank you.
Thank you.
Thank you, madam.
And very soon, BVA will be coming up with a membership drive for 50% discount for the rest of the year. So I request whoever are present here to refer to your friends to become BVA members. Thank you. Have a happy
Thank you.
weekend.
Thank you. Thank you. Bye.
Vijay, you can stop the recording.
Okay, ma'am.